On June 25, 2026, Apple did something it almost never does. Without releasing a single new product, they abruptly raised their prices. Consumers found the MacBook Air was suddenly 18% more expensive, and the iPad Pro jumped 20%. There were no new features or hardware upgrades to justify the extra cost to buyers. Apple's official explanation was startlingly blunt. They blamed soaring memory chip costs, stating the artificial intelligence boom was driving up manufacturing expenses. Without realizing it, everyday consumers had started paying a hidden AI tax. The extra money spent on a laptop was directly funding a massive corporate war being fought over computer hardware. To understand why a laptop got more expensive, you have to look at the manufacturing level. Major South Korean chip factories like Samsung realized they could make 10 times more profit selling specialized memory modules to AI companies. So they quietly shifted 93% of their production lines away from standard consumer memory. That massive pivot created an immediate supply chokehold for regular electronics. Within just 6 months, the wholesale price of 1 gigabyte of standard PC memory spiked from 43 cents to over $2, a 5.5-time increase. This hardware scarcity reveals a much larger problem. The world's tech giants are locked in a blind, aggressive infrastructure race, and it is warping the entire global economy. To see the scale of this race, we have to look at the physical reality of the cloud. When you type a question into an AI, the processing doesn't happen on your phone. It happens inside a data center, a massive, power-hungry, windowless warehouse. A single building like this can hold 100,000 specialized GPUs, which cost up to $40,000 each. By the time you buy chips, lay the high-speed cables, and install the cooling systems, a single large AI data center can cost up to $25 billion to build. To finance this, companies use their capital expenditure, or CAPEX, the budget reserved for buying physical assets. Right now, big tech is pouring an astonishing 94% of its operating cash flow straight back into building this physical AI infrastructure. This chart shows exactly how aggressive that outflow is. In 2020, the top 4 U.S. tech companies spent a combined $90 billion on infrastructure. By 2026 alone, that single-year spend rocketed to $725 billion. These companies are betting virtually all of their available liquidity on one assumption, that global demand for AI compute will eventually be massive enough to justify this historic financial output. Let's run the math on that assumption. Investors generally demand at least a 10% return to justify a risky bet. Wall Street analysts calculated that to support $725 billion in spending, the AI industry needs to bring in $650 billion in revenue every single year. But if you tally up the current earnings of every major AI company combined, including OpenAI, Anthropic, and Gemini, they only generate around $75 billion. That leaves a $600 billion annual revenue deficit that nobody knows how to fill. Big tech assumed that massive corporate clients would happily absorb the costs. Instead, enterprise clients are finding top-tier AI tokens far too expensive, and right now they are actively abandoning the big models for much cheaper alternatives to save their own budgets. Furthermore, corporate adoption is stalling. Researchers at MIT found that up to 95% of companies attempting to integrate AI into their businesses are failing to achieve any measurable financial return on their investment. The core crisis is simple arithmetic. For every single dollar the AI industry brings in, tech giants are spending $10 to build the network. It is an entirely unsustainable economic reality. In economics, there is a recurring pattern called the capital cycle. High expected returns attract massive capital investment, and money keeps flowing in wildly until extreme overcapacity forces the market to collapse. We saw this play out perfectly in the late 1990s. Telecom companies were convinced internet traffic would double every few months forever. In response, they poured $500 billion into laying physical fiber optic cables underground. Internet demand did grow, but not nearly fast enough to justify the immediate cost. By the early 2000s, over 95% of those cables sat totally unused. Bandwidth prices plummeted, major companies filed for bankruptcy, and the market crash wiped out $2 trillion of value. Here's the historical twist. The internet really was the future. Those bankrupt companies laid the wasted cable that eventually became the physical backbone for modern giants like Netflix and Amazon Web Services. The technology survived, but the companies that built it did not. Today's AI boom is slightly different. The startups of the 90s were fragile, whereas today's major AI investors are the most profitable companies in human history. They are well protected against a total corporate wipeout. So where does this leave us? In the first scenario, the bubble pops. The tech giants accept that the deficit is unsustainable, slam the brakes on spending, crash the stock market, and trigger massive job losses across the global IT sector. In the second scenario, these companies race to profitability to cover their massive debts. They drastically hike the price of AI processing, effectively killing off cheap consumer AI tools. The technology simply becomes an expensive luxury, strictly for megacorporations. Artificial intelligence will undoubtedly reshape the economy, but the current era of endlessly cheap digital tools and standard hardware is an illusion, one funded by a ticking $600 billion debt bomb.